Hello everyone, welcome to Business Education and Research. This video presents the comprehensive guide on the stock market basics, specifically tailored for beginners. This presentation will equip you with essential knowledge about how the stock market operates, different types of stocks available, and fundamental investment strategies, helping you to start your investment journey with confidence. What is stock market? The stock market is a vibrant ecosystem where shares of publicly traded companies are bought and sold through exchanges. It acts as a critical hub for economic activity, enabling companies to raise capital and providing investors with opportunities to earn returns on their investments. Purpose. For beginners, it is crucial to understand that the stock market helps in wealth creation and economic growth. It allows investors to own a part of companies they believe in and benefit from their growth while providing companies with necessary funds to expand. For example, imagine the stock market as a large supermarket for investments, where instead of buying groceries, you can buy shares of various companies. Each share you purchase represents a piece of ownership in a company and the potential for return on your investment depending on the company's performance. Types of stocks. Common stocks. Common stocks are the most typical form investors own, providing voting rights and dividends. Investors benefit from the company's profits but also face risk if the company performs poorly. Preferred stocks. These stocks offer no voting rights but typically guarantee a fixed dividend, making them less risky compared to common stocks. They are suitable choice for those who prefer steady income over potential high returns. For example, if you think of a company as a large tree, owning stock is like owning a piece of that tree. Common stocks are like the branches, potentially growing and bearing fruit, but also facing risk of breaking, while preferred stocks are more like the trunk, less glamorous but stable and reliable. How to start investing in stock market? Brokerage accounts. To start investing in stock market, you need to set up a brokerage account with either a traditional broker offering comprehensive services or a discount broker known for lower fees. When selecting a broker, consider the charges, services like financial advice, and the usability of their trading platforms. The stock exchanges are accessible through these accounts, providing a gateway to a variety of investment options. Research. Effective investing hinges on robust research, particularly in the dynamic market. This involves understanding local market trends, analyzing financial reports of companies, and keeping abreast of national economic indicators, leveraging resources like reputable financial news outlets, stock analysis reports, and market trend applications can equip you with insights needed to make informed decisions. For example, setting up a brokerage account is like laying the foundation for a house, where thorough research on materials represents the selection of stocks, ensuring the house can withstand various weather conditions akin to market fluctuations. Understanding the stock market index. Role of index. Market index like Sensex and Nifty 50 are barometers of the Indian economy, reflecting the performance of major companies. They help investors understand market trends and serve as benchmark for comparing individual stock performance or entire portfolio against the market average. Using index. By tracking movements in the index, investors can discern the overall market health and market strategic buying and selling decisions. These indexes also aid in predicting future market trends, offering a strategic advantage in portfolio management. For example, consider market index as the dashboard of a car. Each gauge like the Sensex or Nifty provides a real-time insights into market health, helping investors decide whether to accelerate their investments or apply brakes, akin to adjusting driving speed based on road conditions. Risk and returns in the stock markets. Understanding risk. The stock market comes with its own set of risks, including market volatility, sector-specific risk, and broader economic uncertainties that affect stock prices. Investors need be aware of these factors and consider them when making investment decisions, staying particularly vigilant about sudden economic shifts or policy changes that could impact their investments. Return expectations. Balancing these risks with the potential for returns is crucial. Understanding historical performance, current market conditions, and future economic forecasts can help set realistic expectations for investment returns. This balance is a key to build a resilient investment strategy that can withstand market ups and downs. For example, investing in the stock market is akin to navigating through unpredictable city traffic where being mindful of potential hazards and adjusting your driving according to road conditions can lead to a safer and potentially faster journey to your financial goals. Diversification in investing. Diversification is a key strategy in mitigating risk in your investment portfolio. By investing in a very variety of sectors and asset classes, you can reduce the impact of poor performance in any single area on your overall portfolio. This might mean spreading investments across different sectors like IT, pharmaceuticals, and consumer goods, as well as considering bonds and mutual funds. An example of diversification is like attending a buffet. Instead of filling your plate with just one dish, you try a little bit of many dishes to balance out the flavors and leave satisfied, even if one dish is not your liking. Long term versus short term investments. Understanding the difference between long term and short term investment strategies is crucial for any investor, especially in the Indian market where volatility can be very high. Long-term investments are generally held for several years and can benefit from the power of compounding and greater stability in returns. Short-term investments, on the other hand, aim to capitalize on market fluctuations but come with higher risk. As an example, think of long-term investments like planting a tree where you nurture it for years before you can enjoy its shade or fruits, while short-term investments are like planting seasonal flowers which might be bloom quickly but don't last for long. Tax implications. Taxation can significantly impact your investment returns. Understanding the tax rules related to short-term capital gains, long-term capital gains, dividend distribution tax, and securities transaction cost is essential. This knowledge will help you to plan your investments to minimize tax liabilities and maximize net returns. For instance, selling an equity shares held for more than 1 year may result in a more favorable tax treatment and a long-term capital gains compared to selling it within a year. Similar to how waiting for a fruit to ripen fully enhances its sweetness and worth. Using technical analysis. Technical analysis involves studying historical price movements and trading volumes to predict future market behavior. This approach can be particularly useful in the emerging stock markets for making short-term trading decisions. Learning to read charts and understand indicators like moving averages, RSI, and MACD can provide insights into market trends and potential entry and exit points. Consider technical analysis as looking at a weather map before planning a trip. Just as you would analyze patterns to predict the weather, investors use charts to predict market movements and decide the best times to trade. Common mistakes by beginners. Many beginners in the stock market make common mistakes such as acting on unverified tips, overtrading, and non setting up stop loss orders. Learning about these pitfalls and how to avoid them can save you from unnecessary losses and improve your overall investment strategy. Think of these common mistakes as skipping the instructions of manual of your new gadgets. You might figure out how to use it eventually, but not without pressing some wrong buttons first, which could lead to suboptimal usage or even damage. Thank you for joining us in the exploration of the common stock market basics. Remember, investing is a journey that requires patience, diligence, and continuous learning. With the fundamental knowledge you have gained today, you are better equipped to navigate this journey and make informed investment decisions. Keep learning, stay disciplined, and watch your investments grow over time. Thank you.